Deep dive into why benchmarking private credit is so difficult and how you construct a private credit benchmark.
Non-bank lending in general, private credit came to prominence after the great financial crisis in 2008, and we map it to the Fitch, but many others do not.
Today we're doing things a little bit differently because we are getting a sneak peek into a workshop that we're hosting for some of our institutional partners. And we're going to deep dive into why benchmarking private credit is so difficult and how you construct a private credit benchmark.
Thanks for having me, and thanks for putting me on spot on this one. So that's a workshop we are holding later today. But let's look why actually benchmarking private credit is like a way harder than it looks. Right? So there are three reasons for it. Once the private credit borrowers are usually not rated by a large rating agency like Fitch or Standards & Poor. That's why you don't have necessarily the comparison benchmark. What is the level of risk you are taking when you are buying a private credit instrument? Some private credit originators like us, we do internal rating and we map it to the Fitch, but many others do not, and many do use smaller rating agencies which they have their own scale, which you can need to somehow again benchmark to the regular scale. The second issue is with the mark-to-market. So this is how often do you reevaluate the investment? How many times a year, a week do you see what is the net asset value of the investments? And as the nature of the private market investments, those happen on a monthly basis usually at best. Right, some of them in a quarterly basis. So you don't have this mark-to-market. And how does the fund manager actually value the assets? They have their own methodology. Then you can have discrepancies. Third one is the most peculiar, the potential mask credit losses. So when, for instance, your borrower in your portfolio doesn't have money to pay a coupon, right? Then you will give them another loan so that they are actually able to pay. So this is not a rollover. This is something worse. This is basically you are like putting credit in credit. You are paying from one loan from another loan, right? Servicing one loan from another loan. That's very, very bad situation. But they could be more subtle things like payment in kind. Instead of interest, say, okay, we're not going to take a coupon, we will accrue it. Right, or we will restructure the covenants, or we will restructure the loan to make it longer, and that way you are hiding actually the credit losses, and that makes benchmarking more difficult, and especially more difficult if you are comparing to the public market instruments where the transparency is way higher. But you can still go around it. There's still the way how you can benchmark private assets and private credit in particular. Let me, before I will go deeper into what could you do, let me go what you should not do. So benchmarking any private assets, private credit included, is not about comparing different managers' performance. This is not benchmarking, because you are taking a lot of bias in this benchmark. You are taking a bias of which managers did you choose actually to benchmark that strategy against. Secondly, you don't exactly know if the managers are holding the same proportion of assets in their portfolio, so you can't really know what you are comparing. So you are only comparing gross or net returns between the managers. But you don't know are they appropriate the same level of risk, same level of systemic risk, currency risk, and so on and so on. So there's a better approach to that. The better approach that you should actually comparing the assets, the underlying assets, not the managers. And the way to do it is to manage three fundamental pillars of benchmarking. So one is your beta. Right? What is the overall market doing, and where the overall market, what return has the overall market? In the case of private credit, I suggest as the overall beta to take a US broad private credit index. And here can come criticism why you are taking this one where you are doing emerging market like private credit. But the reason is that we are somehow targeting the same population of investors, USD investors, which want to have non-volatile returns, and they can really choose between investing in a mid and up market in the US or investing in the emerging markets. And given that you have not so many private credit index, I would in this case suffice myself with the broad private credit index, which is going to be US index for sure. That's the only ones which I have seen. Then the second pillar is the allocation alpha. So you can say, all right, so I am within this private credit market, but I am allocating maybe more to the emerging market. I am allocating to the specific industry. So this is the allocation alpha. It's not yet like saying how good is the manager. This is saying, okay, my strategy has 60% exposure to emerging market, 30% exposure to developed market, 10% to frontier market, and I do this kind of size of companies. I do mid-cap companies. So this is allocation. So again, if you would like to compare allocation, I would need to take the same strategies or construct a synthetic benchmark where we would take the same underlying asset, follow the same allocation, and then they should have the similar allocation alpha. Then we can get into the third most interesting pillar, is the true alpha or pure alpha. This is actually the skill of the manager, where they show their mettle. And definition of the alpha would be within the same allocation, within the same risk which I'm taking, can I get better yield? And if yes, I'm actually generating the true alpha. How can I get the better yield? Because I have a better access to deals, because I have a better relationship with the borrowers, because I can close transaction faster. That's why I be rewarded by higher yield, or I can structure in the transaction in such a way that I have a lesser losses on the loans than the rest of the industry. And this is all the source of the pure alpha. And pure alpha cannot be calculated directly. It can be only deducted by taking the gross fund returns, deducting the market beta and the allocation alpha above that. This is actually the true pure alpha of the manager.
So far so good, but this is difficult to benchmark. I can see why it's a headache for portfolio managers or investors.
Yes, it is. It is more. I would say portfolio managers themselves, if they are large, they might have some private market equivalent index and the way how they benchmark things. Researchers, finance researchers, obviously, and sometimes managers like us, we also try to get closer to the truth and embarking on the journey, trying to calculate what is the actual alpha and where we stand within the broad private credit. So I will show rather an example. Let's stop the theory. So the example of us on the left side, you see the overall private credit benchmark. In this case, is the Hooligan-Loki private credit benchmark, which is updated on a quarterly basis. This is the third quarter 2025. Below that, you see US high yield bond index. This is the usual benchmark of the benchmark for the private credit. Interestingly, you can see that there's an average 2.4% difference between the private credit benchmark and the high yield bond benchmark, and this is the debt illiquidity premium of the private credit.
And where do you see the 2.4%? I'm following you now.
On average, if I would be comparing the distance between these 2 points, it will be about 2.4%. And you can see that also the average annual return on private credit is higher than the US high yield bond. In this time period, we have selected that the standard deviation is similar, but that's a little bit of a bias of this selection period. The standard deviation of private credit is generally going to be lower. So this is the beta benchmark, right? Then we go to the allocation benchmark, and here it's even more difficult because at Kilde we are doing a niche strategy, financing non-bank financial institutions, investing in consumer loans and SME loans portfolios, and there are not so many benchmarks which are available to you, and it's quite hard to actually measure those assets outside US. In US we could, but outside US very difficult. So I've picked two benchmarks: US Consumer Finance, Morningstar benchmark, and Europe Consumer Finance, Morningstar benchmark, and the third one as a control, emerging market high yield bond. On the left side was the US, on the right side is the emerging market high yield bond. And here you can see in the 1 year period from the April 2024 up to September 2025, you can see that Kilde has generating on average about 1% monthly return on the strategy with a very low standard deviation, 0.09%, whereas the US consumer finance benchmark generating about half of the returns, but on about 0.46% standard deviation, so which is a 5 times larger standard deviation. The Europe consumer finance index was unlucky in this period, so the average monthly return is slightly negative, but the volatility is practically 10 times more than the deviation on the Kilde strategy. Emerging market bond performed better, but on the volatility 1.29%, so this is about 14 times larger volatility. So that gives you kind of the idea like where we stand with our allocation strategy, and with the pure alpha, are we somehow like doing better or worse? And the conclusion like on all this, like do not compare only the peer benchmarks, which are easily available. It's very seductive. You can go to PitchBook, you can look at the peers and start benchmarking yourself, but it's not a true benchmark. You need to benchmark on the asset level. Define what is your market beta you are measuring yourself against. Document how you construct the portfolio, actually where the portfolio lies, and find the closest benchmarks or create a synthetic benchmark yourself. And the last one, test yourself through the full cycles. And here I have to have a caveat that digital consumer lending, non-bank lending, and generally private credit came to prominence after the great financial crisis in 2008. And we haven't seen a large financial crisis since then. That's why any private credit returns, including ours, that have been tested in sometimes challenging market conditions, like COVID times, but we never faced once in a generational crisis, as was it 2008 or as was 1929 in the US stock market before.
And I have a question also on behalf of some of our investors that are, let's say, single-family offices or HNIs or accredited investors that might be very interested in private credit. They might have some other exposure, but they are definitely not as resource-heavy as some of these large institutions. So are there any tricks or little shortcuts that you can use to benchmark without necessarily having to go really deep and find all of these, like, let's say, benchmarking on the market level and also asset class level and so on and so forth?
So if you are totally new to private credit, you can go to one of the large private credit funds, like as well, and you can see the direction more easily, because those large funds in the US which are investing large cap, they use a variable interest rate. Currently using SOFR is the most popular one, and then you will know where is the direction of travel of the SOFR. So it's either stagnating or going down. So you will see them also the return stagnating or going down. And then you compare with the high yield bond market, and that's your kind of like a rough compass, I would say. It's not a GPS. If you want a GPS, you need to follow the instructions.
Yeah, it could be good enough as a start for people that are maybe a one man or woman show and need to be a little bit fast as well. That's super insightful and very helpful. Thank you, Radek.
Thank you for having me. Hopefully, I didn't bore you too
No, no,
long.
no, this was very good. Thank you.